Hi, folks. This morning's CPI report just told us something big. The Federal Reserve's days of keeping its foot on the market's throat are numbered. And when they finally let up, the fuse under small cap stocks is going to light fast. July's consumer price index, the measure of inflation, rose just 0.2% for the month of July and 2.7% year over year. The core CPI, when we strip out the volatile food and energy components, ticked up 0.3% for the month. That's a 3.1% annualized rate. The trajectory is clear, however. Inflation is cooling dramatically from its 2022 peak. What comes next? History says the Fed won't keep conditions restrictive forever, and when they pivot, we'll see rate cuts, cheaper financing for business, a steeper yield curve, which is a sign of healthier credit markets, and expanded liquidity, money flowing back into risk assets. Since the 2022 bear market lows, the S&P 500 is up roughly 80%. That's the big cap stocks. The Russell 2000, the small cap stocks, they're only up about 32%, and they're still stuck below the 2021 highs. That's historic underperformance, and it's setting up an equally historic catch-up. Small caps have been in their own private recession, while the large cap companies have been rolling right along. Sales are down, earnings are down, CEO confidence in the small caps are down, and employment in small cap stocks are down. And that's a big deal because that employment and in small capitalization land and small businesses, that's really what drives the employment data in the United States. This isn't random. It's Fed policy. The Federal Reserve tightened aggressively, meaning they kept interest rates too high above the neutral rate, even as inflation fell. They've kept what's called real rates too high, and real rates are just rates after the actual inflation number. We've had negative money supply growth for over a year. It just turned back up, and credit-sensitive companies like small caps have taken the brunt of it. Here's why the Fed pivot to a less restrictive policy will hit small caps the hardest on the upside. Cheaper financing, lower rates reduce their borrowing costs, and they borrow from banks. Credit market revival. A steeper yield curve helps small business lending, which means that the local banks and the small businesses and even the small cap stocks, they're going to go to a bank and they're going to get their lending, or the lending follows through. There'll be an export boost because a softer dollar is going to improve the competitiveness of their products, and there'll be a risk appetite. Liquidity flows back into growth assets when we have this kind of credit market when the Fed pivots. Don't wait. In past cycles, small caps didn't just catch up. They ripped higher for either years or some period of time afterwards. Those rallies started suddenly and moved brutally fast. If you're waiting for the small caps rally, 10% in a week headline, you're already too late. But when the time comes, which I think is now, own quality small cap companies. Those are companies with strong balance sheets, durable cash flows. Avoid the junk because not every small cap will benefit equally. We want you to stay disciplined. Only buy great businesses, not just the cheap tickers. So the Fed pivot is coming. Small caps are sleeping still. The question is, when they wake up, will you already be in position to win?